Everybody, today I want to talk about the dumbest stock trading moves. Many times people really lose a lot of money really because of just a couple of dumb stock trading moves. And trust me, I've made my share when I started out trading 20 years ago. And what I want to do is I want to share them with you, because if you can avoid making these dumb moves, then you can avoid the number one reason why people underperform the market is just really making a couple of bad choices. Because a lot of people, they do 90% of stuff right when investing in the stock market, but these 10% things that they do wrong really accounts for underperformance in the market. So the first dumb move is when you're averaging losers, or as they also say, trying to catch a falling knife. This has happened to me. One of the great examples that happened to me was when the tech market started crashing in 2000, and I started buying more shares of these tech stocks as they were falling, because I figured they were going at a discount. Now here's what happens. Buying stocks that are going down and at a discount, it's actually not a bad move. But here's the problem. Psychologically, at a certain point, you're going to dump that entire position, because when you start adding money to a position that's falling and you're seeing your losses get accelerated, it's going to bother you. You probably say, well, no, I'm psychologically strong enough to handle it. No, you're not. No one is. Hedge funds, they do the same thing. They fall into the trap of averaging downward, and they can't take the pain. And I couldn't take the pain during the tech crash, and you won't be able to take the pain. So do not. It's called losers average losers. So don't average down on a stock. In fact, what you want to do is you want to do the opposite. You want to add to a position that's going upward. I know that sounds counterintuitive, but it's the people who think counterintuitive are the ones that make money in the market. Doing what everybody else does, trying to catch a falling knife, these are the people who underperform the market, and they're the ones who get killed. So whatever you do, don't average losers. Don't buy stocks that are going down. The second dumb move is when you're over leveraged or you're using leverage. I would say never ever buy a stock on margin. I know it's very tempting. I know a lot of people are like, hey, if this stock is going up 100% a year, I might as well buy it on margin. Very, very bad idea. And one example I want to give is probably one of the best stocks you could have owned over the past 5 decades is Berkshire Hathaway. If you have owned Berkshire Hathaway on margin over those 50 years, you would have been wiped out 3 times, because in those 3 times that this stock, Warren Buffett's stock, has been able to get average returns of 25% over the past 50 years, 3 times Berkshire Hathaway had lost 50% of its value. So if you had owned that stock on margin, you would have been wiped out. Warren Buffett mentioned that in an interview, why he never owns stock on margin. It's just, if all a stock has to do, if you own a 2-to-1 margin, that stock just has to get cut in half, which is very, very common. Even the biggest blue chip companies like Coca-Cola, Walmart, they all get cut in half over at least once a generation. So you do not want to own stock on margin. If you do want to own more stock for less money, then consider options. But options are, again, that's another risky. I would only own options as a long-term trade. Like if you buy options that expire 1 year out as a position. But even then, if you're new to the stock market, I would avoid options altogether. And finally, the last dumb stock move is overtrading. Now, here's the problem. Overtrading in itself isn't bad if you have a plan. So let's say, for instance, you want to buy stocks that typically go up during a certain time of year, like during the year of December, tech stocks usually go up. So if you're like, I'm going to buy tech stocks and just hold it for the month of December and then get out on December 31st, like buy a tech stock on the first trading day of December, sell on the last trading day of December. That makes sense because you've got an entry strategy, you've got an exit strategy. But a lot of people, they just overtrade. They just end up, they hear about a stock and then they buy. If the stock goes up, they sell it. If it goes down a little bit, they sell it. They're overtraded without any real strategy. And what happens is all those trading fees, they can eat away at you. Of course, I know if you use the Robinhood app, you could eliminate that problem. But the problem is, though, the more you overtrade, the more likely you are to adapt strategies that are not going to make you a lot of money and not going to overperform, because you're not going to be focused. because it's impossible really to focus on more than a couple of stocks, to do all the research on a couple of stocks. And when you overtrade historically, you're going to underperform the market. So I would avoid overtrading. If you do want to use short-term trades, as I said, you want to know when you're going to get out before you get in. You want to have an exit strategy before you have an entry strategy. So these are the 3 dumbest stock trading moves, which is averaging down losers, buying stocks on margin, and finally overtrading. Avoid these 3 pitfalls, these dumb stock trading moves, and you're going to do all right. Okay, so I hope you enjoyed this video. If you did, please be sure to like, share, and subscribe. Thanks. Bye.